Welcome back to the deep dive. Today, we're pulling back the curtain on the UK's financial regulatory system, specifically the two big players, the Prudential Regulatory Authority, or PRA.
And the Financial Conduct Authority, the FCA.
Exactly. If you're trying to figure out who's really in charge of the banks, the insurers, even your financial advisor, well, you're in the right place. And we want to understand how this structure, this sort of dual command, has evolved, especially since the old 1986 Financial Services Act.
Yeah, and you really have to start with the philosophy behind it all, because that explains why we have the system we do today. If you go back a few decades, regulation was, well, it's mostly a checklist. Very process-driven, very rules-driven.
Right, the tick box approach.
Precisely. And the big problem with that was firms could just, tick the box. They weren't necessarily thinking about the spirit of the rule or, crucially, the outcome for the customer.
So what changed?
Well, the modern approach is fundamentally different. It's risk-based and principles-based.
Yeah.
The regulators actually say up front, look, preventing all failure just isn't realistic. And having too many rigid rules can actually smother innovation.
Okay.
So instead of micromanaging processes, the focus shifts to outcomes. They set broad principles, guiding philosophies, and force firms to think much harder about managing risk, not just filling forms.
Okay, let's dig into that principles-based approach then, because it sounds like the foundation for everything else. Our sources break it down into sort of three core elements. First, setting those broad principles, the big picture goals, the desired outcomes. Second, you need a way to assess potential risks proactively. So looking ahead, thinking about the impact on customers, on the whole system.
And whether a firm's actions might actually undermine the regulator's own objectives.
And the third part.
Pure proactivity. It's
Sure.
not about waiting for a disaster anymore. The regulator has to have systems in place, monitoring things, trying to spot potential problems early.
So they're trying to predict the future almost.
Or at least head off the worst outcomes, yeah. That's central to the modern compliance culture.
Okay, so a shared foundation of principles.
Mhm.
But then we get to the division of labor, right? Who actually does what?
Exactly. And to understand that, you need to grasp the two main types of regulation.
Go on.
Think about two kinds of stability needed. First, there's prudential regulation. This is all about financial safety, the structural soundness of the firm.
Like, can it actually pay its bills? Does it have enough cash?
Precisely. Can it meet its obligations? Does it manage risk well? Does it have enough capital, enough resources to weather a storm? You could say this regulator is like the structural engineer.
Okay, engineer. What's the second type?
That's conduct regulation.
Yeah.
This is purely about behavior. How does the firm interact with the public?
How they market stuff, sell things, handle complaints.
Exactly that. Dealing with you, the customer, ethically, clearly. This regulator is more like the customer service watchdog, ensuring fair play.
It's interesting, though, that even with different jobs, both the PRA and FCA have to follow 9 mandatory principles.
That's right.
And some are obvious, like efficiency, but 2 really stand out as showing that philosophical shift we talked about.
Which ones are you thinking of?
Well, first, proportionality.
Ah, yes, that's a big one. It's basically saying the burden on a firm has to match the expected benefit of the regulation.
So you don't ask a tiny credit union to do the same mountain of paperwork as a giant global bank.
Exactly. It acknowledges that compliance costs real money and time. It's a direct response to past complaints about regulators maybe going too far. And it's quite relevant now, post-Brexit, with the UK wanting to stay competitive.
Makes sense. And the second one, this one feels, well, maybe more controversial. Consumer responsibilities.
Absolutely. This principle basically states that consumers have to take some responsibility for their own financial choices.
Provided, and this seems crucial.
Yes, provided they're given the right information and suitable advice. It stops the regulator being put in the impossible position of guaranteeing every single investment someone makes.
So it's a balancing act. Protect people, especially vulnerable ones, but don't wrap everyone in cotton wool so they can't make informed decisions or take calculated risks.
It's a very tricky line to walk. Avoid being too paternalistic, but still ensure proper safeguards.
Okay, that distinction, structural safety versus customer behavior, leads us perfectly to the two bodies themselves, PRA versus FCA. Let's define who regulates what.
Right. So the PRA, they take that engineer role, as you put it. They handle the prudential regulation, the safety and soundness of the really big systemically important firms.
We're talking major banks, building societies, the big insurers, major investment firms.
Yes, the ones whose failure could genuinely threaten the whole UK economy. But and this is important, the PRA is not generally responsible for the conduct of these giants.
Ah, okay. So who is?
That's where the FCA comes in and where things get a bit more layered. The FCA is responsible for the conduct regulation of basically every financial firm in the UK, big or small.
Right.
But here's the twist. The FCA also does the Prudential Regulation for around 50,000 smaller firms.
So financial advisors, mortgage brokers, smaller insurance companies.
Exactly. Their collapse would be bad for their customers, obviously, but probably wouldn't bring down the entire financial system.
Okay, so PRA, Prudential for the giants, FCA, conduct for everyone, plus Prudential for the smaller guys.
Got it.
Let's focus on the PRA for a moment then. What are their official goals?
Their statutory objectives really underline that safety focus, promote the safety and soundness of the firms they watch, protect insurance policyholders. But their mandate has broadened too. They also have to facilitate effective competition and, interestingly, support the international competitiveness and growth of the UK economy.
Balancing stability and growth, that sounds tough.
It is a constant tension.
And a key tool for that stability goal is monitoring capital adequacy, right? This always sounds very technical.
It can be, but the concept is pretty simple. Think of a bank having two main sources of funds.
Yeah.
Customer deposits essentially borrowed money and its own funds, which come from shareholders. Equity. Capital adequacy rules just say that the bank's own funds, the shareholder capital, needs to be big enough to act as a cushion, a buffer,
Why?
so that if the bank makes losses on its loans or investments, the shareholders absorb those losses first. That buffer has to be used up before customer deposits are ever at risk.
Right, protecting the depositors.
Exactly. And this is measured by things like the solvency ratio. But crucially, it's not a flat ratio. It reflects risk.
How so?
If a bank holds lots of very risky assets, it's forced to hold a bigger capital buffer, more owner's money relative to its risky activities. It's like demanding thicker walls for a building in an earthquake zone.
Got it. It's the ultimate safety net for the system.
Pretty much.
So that deep technical safety focus of the PRA, how does that contrast with the FCA's main job?
Well, the FCA's top-line strategic objective is much broader, making sure relevant financial markets function well, smoothly, fairly.
And beneath that?
3 operational objectives, and you can immediately see they're more customer-facing. First, protect consumers from bad conduct. Second, protect the integrity of the UK financial system, so fighting market abuse and financial crime.
Okay.
And third, promote effective competition, specifically in the interests of consumers. It's all about trust, transparency, fair dealing.
Which raises a big question. With conduct for everyone and Prudential for 50,000 firms, how on earth does the FCA actually supervise all that? They can't be everywhere at once.
No, they absolutely can't, which is why their whole approach is defined as oversight, to reduce actual and potential harm. The key words there are potential harm.
Meaning they try to look ahead.
Exactly. It's inherently forward-looking. They don't just wait for complaints to roll in. They spend a lot of effort analyzing things like firm culture and governance.
Like culture.
Because they believe, and the evidence often backs this up, that a poor internal culture is often the root cause of future misconduct and customer harm. Get the culture wrong, and problems will follow.
That makes sense.
And this proactive approach also means focusing heavily on individual accountability, especially senior managers who signed off on this, who set the tone.
Holding people responsible, not just the firm.
Yes. And it required a lot of communication, talking to the industry, talking to consumer groups, trying to get a feel for emerging risks.
And given the sheer number of firms, they must have to prioritize somehow.
They do. They triage based on potential harm. You have the biggest players, or those posing the biggest risks, categorized as fixed portfolio firms.
And they get
Dedicated supervisory teams. Constant proactive oversight. Everyone else falls under the general supervision team, which uses slightly different, perhaps more reactive or thematic methods.
You mentioned thematic work. How does the FCA actually divide up its supervisory efforts day to day?
They generally talk about 3 types of work. First is that proactive stuff we've been discussing, trying to identify harm before it happens, looking at business models, cultural drivers, new products. Then there's reactive work. That's dealing with problems as they emerge or after they've happened, responding to intelligence, dealing with specific breaches.
Right, the firefighting.
Kind of. And third, there's thematic work. This is really interesting. If they start seeing the same sort of problem popping up across multiple firms, maybe bad advice on a particular investment.
Like pension transfers, perhaps.
Exactly. That's been a huge area. They might launch a thematic review. They'll look at the issue across the whole sector or as a segment of it. diagnose the root causes, and then often apply broader fixes or guidance. It's about cleaning up systemic issues, not just chasing individual firms.
And part of that proactivity involves listening to external warnings too, right? Like super complaints.
Yes, that's a specific power. Designated consumer bodies, like which, can make a super complaint if they believe a market feature is significantly harming consumers. The FCA then has a duty to investigate and respond publicly.
Okay, so supervision tries to prevent harm, but what happens when things go wrong? Let's talk about enforcement, the consequences.
Right, because prevention isn't always possible. The FCA has explicit duties around preventing financial crime, money laundering, fraud, bribery. And they can take immediate action, like banning a misleading advert almost overnight if needed.
But for bigger issues.
They have significant enforcement powers. They can launch formal investigations if they suspect misconduct, things like insider dealing, providing false information to the regulator, serious mis-selling.
And if they find wrongdoing, what's in their toolkit?
Quite a lot, actually. They can vary a firm's permissions, basically, tell them they're no longer allowed to do certain types of business.
Hit them where it hurts.
Indeed. They can demand restitution, forcing a firm or individual to give up profits they made by breaking the rules.
Getting the money back.
Or they can seek court orders for redress, making the firm compensate customers for losses. Though often the Financial Ombudsman Service or the compensation scheme might handle individual redress first.
And the ultimate sanction.
Criminal prosecution in the most serious cases.
Let's put some numbers on this. You mentioned the enforcement actions have teeth.
They certainly do. If you look at the period January to November 2024, the FCA issued fines totaling, wait for it, over $176 million.
Wow. 176 million. That's serious money.
It is. And it shows they're willing to impose significant penalties for failures.
Can you give some examples from that period? What kind of things trigger these fines?
Sure, there were cases hitting individual systems and core conduct. For individual accountability, the former director and compliance officer of a firm called London Capital and Finance was fined nearly £32,000 and banned. Why? For signing off on financial promotions that were deemed recklessly unfair and misleading.
So targeting the person responsible for compliance.
Directly. Then, in the systems failure category, Macquarie Bank's London branch got a fine of over £13 million.
What went wrong there?
Their internal systems and controls were so weak that a trader managed to hide huge losses, hundreds of millions, using hundreds of fake trades over nearly 2 years. The fine was for the failure of the systems that should have caught it.
A failure of oversight.
Precisely. And then, a really stark example of core conduct failure. An individual advisor was fined over $1.3 million and banned from the industry completely,
For?
giving unsuitable advice on pension transfers, a recurring and very damaging issue. These examples really show the real-world impact of breaching those conduct principles.
Okay, so the enforcement is clearly robust, but you mentioned a policy change in 2024 that sounds quite significant.
Yeah.
About naming firms earlier.
Yes, this is a really critical development to watch. Historically, the FCA usually only named and shamed a firm after an investigation concluded or a decision was made.
Standard practice, you might think.
Right. But in early 2024, they announced a major shift. They intend to start naming firms much earlier in the investigation process.
While the investigation is still ongoing.
Potentially, yes. The justification is based on public interest. They argue that naming a firm under investigation might encourage witnesses, maybe current or former employees, or affected customers to come forward with information sooner, helping the investigation.
That's quite a change. It gives the FCA huge leverage, doesn't it? Just announcing an investigation could hammer a firm's reputation.
Absolutely. It's a significant increase in transparency, but it also raises questions about fairness and the potential impact on firms before any wrongdoing is actually proven. It's a space to watch.
Definitely. One last point. Let's loop back quickly to the FCA's prudential role for those 50,000 smaller firms. You said the goal isn't always preventing failure.
For most of them, no. Because their individual failure, while damaging locally, usually doesn't threaten the whole system's integrity. So the FCA's aim there is more about managing failure cleanly, ensuring an orderly wind-down, minimizing harm to customers, maybe ensuring client money is protected.
But there's an exception.
Yes, they do identify a small number of these firms as P1 prudentially critical. These might be firms that, although smaller overall, play a crucial role in a specific market niche. For those firms, the FCA does aim to reduce the probability of failure, much like the PRA does for the giants.
Okay, that clarifies the nuance there. So let's try and tie this all together. We've got this dual structure, PRA and FCA.
Yep, PRA is the structural engineer for the big guys,
Yep.
focusing on capital, solvency, systemic risk.
And the FCA as the conduct regulator for everyone, plus the prudential supervisor for the smaller firms, focused on fair treatment, market integrity, competition.
And the overarching theme is this shift towards principles-based, risk-focused, proactive regulation, looking at outcomes, culture, individual accountability, not just ticking boxes.
It really sounds like a complex balancing act,
It absolutely is. You're trying to protect consumers robustly, maintain financial stability.
but without stifling innovation or making the UK uncompetitive internationally.
Exactly. It's a constant calibration.
So, thinking about this from the listener's perspective, what's the key takeaway? Regulation isn't static, it's constantly evolving to meet new risks.
Definitely. And the regulators have powerful tools, both for supervision and enforcement.
Which brings us to a final thought. That new FCA policy you mentioned, naming firms under investigation much earlier, aiming for greater transparency and encouraging witnesses. How do you think that policy plays out against the traditional idea of innocent until proven guilty in a market that runs so heavily on reputation and trust? Where does that balance lie now? That feels like something really worth keeping an eye on in the coming years.